Hello, everyone. My name is Rob Boff, and I'm a senior ESG analyst with Bloomberg Intelligence. I'm excited to be speaking with a wonderful group of panelists to discuss best practices for proxy season. Please join me in welcoming them to our virtual stage. First, we have Rebecca Boon, partner in the New York office of Bernstein, Litowitz, Berger, and Grossmann. We have Michael OLeary, managing director at Engine No. 1, and Paul Washington, executive director of the Conference Board's ESG Center. Quick reminder to the audience before we begin, we want to hear from you. If you have any questions for our panelists, please post them directly in the event chat. We'll save some time at the end for a little Q&A. So 2021 was quite an extraordinary proxy season for ESG investors. It was a record year for environmental and social resolutions, both for overall voting support and the number of successful proposals. On top of that, we saw oil giant Exxon lose a proxy contest to Michael's firm, Engine No. 1, largely for environmental reasons. So I guess first I'd like to go around the room or around the monitor, hoping you all can share what you think were the big takeaways from the most recent 2021 proxy season. Let's start with Paul.
Sure. ESG proposals are here to stay. They're getting much more support than in the past, and notably, more of them are passing. So average support is higher, and the number of proposals that are passing, sometimes with extraordinary numbers, have really increased. The proposals that are getting 70, 80% support are including some new ones relating to disclosure of EEO1 data and so forth. So it's ESG, it's a wave, it's not temporary. It's only increasing. And I think another key takeaway is the alignment often between activist investors and mainstream investors. We have seen the big index funds who care about systemic risk focus more on environmental and social proposals than in the past. Their support is increasing. But now we're seeing activists as well sort of joining forces. We saw that in the Exxon case, but I think we're going to be seeing it more broadly. So there's no respite.
Great. Rebecca, any insights from you?
Sure. Just to echo that, I mean, we're really seeing activist investors push for social change and positive social change, for the first time. And that momentum's really, I think, continuing. We saw it in the environmental context with Exxon, but we're also excitingly, I think, seeing it on social issues. And we saw that with Microsoft and Goldman. And two additional points I would make is just that size doesn't seem to matter that much in terms of making these proposals successful, and that even tiny activist investors are having success. And then the second point I would make is that major institutions, as was just alluded to, BlackRock, the big three, are coming out vocally in support of these shareholder proposals. And I completely agree that that momentum, from my perspective, is just going to continue into 2022 as well.
Great. And Michael, anything exciting happen to you in this last proxy season?
Well, it's a great point that Engine No. 1, we owned, I think, 2 basis points of Exxon stock when we launched that campaign. I think one thing that the last proxy season shows is that always in any activist campaign, you are only as strong as the coalition you can put together. And especially with a campaign like this, we will only be able to be successful in putting on new directors if we could convince 49.981% of other shareholders of our argument. And in many ways, our campaign was built on a very simple premise, which is that environmental issues are economic issues, and that you cannot create long-term value in the energy industry unless you're focused on the energy transition. And so if you're the 5th largest greenhouse gas emitter in world history, as Exxon is, and 2/3 of your business comes from countries that have themselves set net zero targets, you don't have a sustainability problem, you don't have an ESG problem, you have a core strategic problem, and that you need to gradually, purposefully start to transition that business. And that's the case we made. The economic case to shareholders, I think one thing that we took away from this proxy season beyond our campaign, looking at successful proposals at Chevron, at DuPont, at Delta, or American Express, one of our takeaways is that investors are starting to understand that these are core economic questions. These are long-term drivers of shareholder value. And so even though they kind of get boxed off as ESG proposals or ESG issues, it's still talking about creating long-term value for shareholders.
Great, and that kind of brings me, again, not to box everything into ESG, but I think that's kind of a familiar lens for folks. So, I did want to dig a little into, how we look at proxy season through each of those three lenses. So, I guess starting with the environmental proposal, we've heard a great deal of promise coming out of COP26, but as we all know, kind of talk is cheap. So, Michael, how much momentum do you think will carry through into the AGM season, and what can activists such as yourself do to make sure that words are turned into action?
Yeah, it is remarkable to think that just 2 years ago, 2019 proxy season, not a single climate-related proposal passed, right? And 3 passed last year, and something like 11 passed this year. And I think it shows that, and COP26 is a great example of this, that climate is becoming a big tent issue for investors. And I think you'd be hard-pressed to find a CEO or a large investor today who did not at least pay lip service to the idea that climate is an important driver of economics for companies. A lot of the success of proposals is being driven by the large multi-trillion-dollar asset managers who've gone truly remarkable, in year over year in support for ESG proposals. The problem, the risk, though, is that as it becomes a big tent issue, that it also becomes very noisy. Every company, every investor is now making the same pledges, saying the same talking points. There's a survey of CEOs a few years ago where they asked, how important is it to you to serve your stakeholders beyond your shareholders? And something like 9 out of 10 said, oh, it's important to me, to serve my workers, the communities, the environment. And then they asked, and how satisfied are you with the job that your company is already doing? And something like 95% said, oh, we're already doing a great job. Right? And it's this risk that it becomes a talking point, but nothing underlying about the companies is transforming in a way that we actually need. I think that's where accountability becomes key. Accountability through standards like SBTI or through SEC standards that might come down in 2022, and also accountability through investors. Ultimately, that's where the buck stops.
Great. And speaking of accountability, moving from E to the S side, we have seen kind of the step up, in holding companies accountable, starting with Me Too a few years ago, and more recently around racial equity. Rebecca, you just mentioned this. We saw a proposal at Microsoft around sexual harassment, and certainly, Microsoft is normally considered a leader in ESG, but the fact that management was against this proposal, but we still saw over 75% shareholder support. Why do you think investor interest is picking up here, and how do you think it's shaping up in the next year?
Well, I think Microsoft's a great example, and there are really 2 key issues. The first is this recognition by companies that these are critically important issues, and legally speaking, within boards of directors' fiduciary duties. And that's really a novel concept that's only taken off over the past few years. Traditionally, these types of human resources issues were considered to really be part of, board of directors' purview. And I think the second point, I would really just echo what Michael just said about the economic case. And I think there's just real recognition by companies that a failure to progress on and address these types of social issues has actual real financial harm. And you mentioned Microsoft, a very recent example, 78% of shareholders voted in support of that resolution last week, which was to compel the company to issue a transparency report, essentially disclosing to investors what's going on with employee misconduct and harassment issues at the company. And another recent example that I thought was really interesting is Goldman Sachs. And there in April, again, kind of spawning from a class action lawsuit involving allegations of harassment and discrimination, where Goldman compelled, over 1,000 women to go into arbitration, a very small activist investor put forward a proposal that was designed to force Goldman to kind of come to terms with its mandatory arbitration policy and disclose to investors how it was impacting its workplace and its workers. Goldman opposed that. Shareholders ultimately voted in favor of it only by 49%. But then months later, Goldman completely reversed course and came out in support of the proposal. So again, shareholders have power. A failure by corporations to act on social issues has real, meaningful economic, financial consequences for the company. And I think those are our big picture takeaways, from 2021.
Yes, certainly. And last but certainly not least, corporate governance, only because it's that last letter in ESG. Turning to you, Paul. While shareholder support for E&S proposals continues to rise, we have seen a decline in shareholder support for management, particularly in say on pay votes. Also, another aspect of the proxy campaign was kind of this lack of industry expertise among the incumbent directors. Is this something we should continue to expect more of? Going after the directors directly.
Sure. And it's a little bit of a tale of two cities. Before I do that, if I might, I just want to comment on the notion of the shift from stockholder to stakeholder capitalism. Mentioned the conference board report that's out on that, where we actually surveyed executives around the globe. 90% think that this is a real shift underway. 80% say it's happening at their company. But what we did that's different from what might have been done in the past is we sat down in roundtables with CEOs, CFOs, GCs, and so forth to talk about what the shift from stockholder to stakeholder capitalism means for them. And I think they now understand that those who embrace this shift are not only going to do well for their company, they're going to do well for themselves. So I think there is a growing recognition that's happening within the C-suite that the change is underway here, and and it's not just risk mitigation; it is positive business opportunity that's made available to them, positive ability to motivate to motivate their employees. So and to create new products and services and unleash innovation in ways that haven't happened in the past. So I do think there's a bit of recognition, but when it comes to let's talk about say on pay. Generally speaking, you're right. We did see some decline in an increase in the number of failed say on pay votes, but overall, generally speaking, most companies are getting above 90%. Here's the exception. It's the big companies. The big companies, we saw 48%, only 48% of them got 90% or above support. And a lot of them saw, and 18% of them had failed votes. So at big companies, there is a lot of investor scrutiny on pay packages. And it's a disconnect between pay and performance, it's special grants, it's those sorts of things that were done in the wake of the pandemic. So expect, especially at big companies, a focus on exec compensation, partly because the quantum of compensation is so much greater there. Focus is going to be there. It's the opposite when it comes to director elections. Yes, we've seen an overall decline in support for directors in the past few years from sort of 98% to 94%, still pretty good grades. But what we're really seeing is that the smaller companies, significant decline in support. So the number of, for example, directors who got less than 70% support, which is just a C, right? That grew overall in the Russell 3000 from 86 directors who failed to get 70% to 308 in the past year. Over half of those are at smaller companies. And the reason there is it's because they don't have good ESG oversight. They don't have board refreshment. They don't have board diversity. So I think that there's a real focus on smaller companies when it comes to director competency and some of those basic things about refreshment, tenure, diversity. The big story for large companies here and the opportunity for large companies to address when it comes to director competency is not to just do the check the box, oh, we've got a cyber expert, oh, we've got an ESG expert, oh, we've got a human capital management expert. The real challenge for big companies is to explain why their directors have fluency in these topics. This is an area where companies aren't great at letting investors know what they're doing. And the best way to demonstrate fluency is through direct engagement between your directors and your shareholders at these bigger companies with your bigger investors, so people can see, yeah, our directors actually understand our company's strategy. They understand these broader ESG issues.
Great. So now I did want to look ahead with shareholder proposals gaining more momentum. It seems like the nature of shareholder engagement is also evolving, and I'd like to touch on this a little. So starting with Michael, you guys recently announced a stake in GM, but the tenor of that announcement was significantly, shall we say, more supportive than with Exxon. So, how would you kind of compare and contrast those two campaigns?
I think oftentimes shareholders get painted with this broad brush of being short-term focused, focusing almost entirely on shareholder metrics like net income or earnings or share buybacks. I think the reality is, especially for shareholders, for investors who have a long time horizon, for investors who understand that creating value requires you to focus on things like your environmental impact or the wages you're paying to workers, the diversity of your workforce, the shareholders can be very supportive in insulating management from maybe the other short-term pressures they might be under. And that was very much our goal with General Motors. Right now, it's a fascinating time to be investing in the auto space because we know with almost 99% certainty that the auto sector 15 years from now will have completely transformed the underlying technology that drives vehicles. Right now, something like 98% of cars sold today are still internal combustion engines worldwide. By 2035, if you take the pronouncements that companies have made, the legislation, the regulations that different states, different countries have made, there will be a whole-scale transformation where that will flip. And we might see a world where 98, 99, 100% of cars and passenger vehicles are electric. Now, that was going to require an immense amount of investment, an immense amount of long-term thinking. And the biggest risk to the incumbent auto manufacturers, folks like GM or folks like Ford, is that they underinvest in this transition and find themselves 10 years from now sitting behind not just the Teslas of the world, but Tesla and the next 5 pure play electric vehicle companies. And so with GM, what we tried to do, and I think we'd hold this up as a maybe more typical model of how we're going to be approaching engagement, is to say we found a company where we actually believe strongly the leadership has the right idea, that Mary Barra and her board have laid out the right plan for transforming that business. And now the biggest risk is not that management's going to take it off the wrong track, but that all the other pressure to meet short-term earnings expectations, continue to milk higher margin internal combustion engine profits, that will get in the way of actually making the long-term transition that matters for shareholder value. And so I think this sort of engagement work where you can both be trying to change management or change leadership or support management, support leadership, but in either case, be an active owner, where we believe that our impact is defined entirely by what we can do through the votes we cast, the engagements we can run, that this is going to be where the ESG space continues to develop away from the more traditional exclusionary approach or divestment approach.
Absolutely. Although, even though certainly we are seeing a lot more cooperation between corporate boards and activists, I think, these things can still be somewhat contentious. So Paul, like to turn it over to you. One of the things, I've heard recently is that, boards have been kind of taken by surprise over how quickly investors are demanding action. They think they have a good engagement and then all of a sudden they're being voted out. So what's your take on that?
That's exactly right. And it's not a topic that a lot of companies want to go public with, but we've heard it from many companies that they were caught by surprise that sort of patient capital became a lot more impatient this year. So you would have members of the board, not just management, members of the board engaging with some of their major investors. They talk about a shareholder proposal, and the investors provided assurance to the board members that, we're with the company. You haven't done 100% of what's in the proposal, but you're doing 90%, and you've given a commitment to do more. We understand why things are moving at the pace they are. And then the votes came in favor of the shareholder proposal and against the company. This happened over and over again this most recent proxy season. And there are some, on the one hand, I understand why patient capital became impatient. They're under pressure from, they're just asset managers, right? They've got their own clients who are looking for more progress. So they're responding to some real pressures to move faster. And sometimes internal decision-making at investors or, the people you're talking to are not necessarily the people who are then ultimately going to cast the votes, because that's often done by a proxy voting committee, right? So I get all that. But the risk that's happening is that companies themselves, like investors, are not monolithic, right? And if the sort of, call it the good guys in the company who are trying to do the right thing to move ahead on environmental and social issues suddenly feel as if the legs are cut out from underneath them because they reported back and say, hey, wait, we've got investor support, we're doing the right thing. But if you think you're doing the right thing and you're still getting undercut by your shareholders, it undercuts the case to be made within a company to continue to make progress, at least for some. So we may be heading to a situation where some companies are just going to say, well, forget that. Sorry, those precatory proposals, we're just going to ignore it because it doesn't seem to make a difference whether we're doing the right thing or we're not. We still aren't getting shareholder support. I don't think that's the right answer. I actually think both companies and investors need to look at the long term. But this was a major under the radar sort of dynamic that happened in this year's proxy season.
Yeah, I can certainly understand that frustration. But then besides proxy campaigns, Rebecca, maybe you can talk us through some of the other levers shareholders have to drive change at the corporate level?
Sure, absolutely. And I mean, I think as a litigator, I'd be remiss if I didn't talk at least a little bit about litigation. But I mean, to Paul's point, times are changing. Shareholders aren't waiting for corporations to act. And in the situations that, I've been involved in prosecuting, where corporations and boards of directors in particular haven't done anything or haven't done enough, for a decade, and sexual harassment and Me Too type issues have been allowed to persist and fester for years and years and years. I mean, certainly, I think in that context, you can see why there is this frustration and why shareholders are resorting to litigation in order to really compel corporations to act. And I mean, in terms of ensuring that the change at corporations is really meaningful and serving long-term goals, I mean, mostly, I represent institutional investor clients who are those types of long-term investors. And we think a lot about how do you actually change the culture of a company for the long term. And I think there are really two key features that we focused on, which is a level of objective, criteria, a level of outside expertise. But to Paul's point, you need those outside experts to work together with the company, because if change is simply imposed from above, there's going to be resistance. It's not going to be meaningful. And then second is just public accountability. What gets measured gets done. And I think that companies who, are forced to, or voluntarily in some instances, set metrics and report their progress on those metrics in an objective, meaningful way, I think that's the way that you gain, or at least one way that you gain more credibility with your shareholders and investors.
Great. Okay, we are, I did want to leave a little room for some Q&A, but just real quick, I wanted to get kind of your quick hit thoughts, predictions on 2022 and what are maybe some of the surprises you might expect. So I guess maybe we'll start with Michael.
There's a lot of focus, rightfully so, on the technology we need to develop at the corporate level, the technology we need to develop to meet the demands of climate change, whether it's green steel or green concrete or electric vehicles. And I think one thing we will see in 2022 and beyond is a continued focus on the innovation we need in the financial sector as well, and different sorts of funds, different sorts of fund structures. And this is an area that we will continue to see innovation. Probably difficult for a lot of kind of retail investors to be able to parse through, but we will continue to see kind of this burgeoning space of folks trying to figure out what's the right way, as an investor, what's the right way to play these trends and ideally help direct them.
Great. And Rebecca, your thoughts for this upcoming year?
I don't see the momentum from Me Too really slowing down anytime soon. I mean, I think we saw some concrete examples in the proxy fight context this year with Microsoft and Goldman. We've seen some very recent, litigation successes in the shareholder context. L Brands is a brand new one. Pinterest was just announced, I think, last week. So it seems like, every single day we see new public revelations of this type of misconduct. And I don't see, again, the momentum in terms of shareholders demanding real meaningful change to address those issues slowing down at all. If anything, I see it increasing in 2022.
Yeah, absolutely. And to add to that list, I mean, Activision, we're kind of seeing that play out as well. You're now seeing workers walk out And in an industry that relies heavily on skilled labor, having that dissatisfaction has real economic consequences. Paul, do you have any thoughts on what to expect in the year ahead?
Yeah, I think investors and companies may be heading for a bit of a collision course on proposals, under the ESG proposals. I think you're going to see more proposals on ENS than in the past. I think that proponents will be less willing to compromise because several S as well as E proposals got either high or majority support. So there's going to be a reluctance on the proponent side to sort of cave a little bit. Some companies were frustrated by this proxy season, and they're going to say, well, forget it. We can't meet them. So they're going to be less willing to compromise. This is all against the backdrop of pending SEC rules. So you may not get the sort of natural private ordering as everyone is sort of staking out their positions and holding firm to them as the SEC rules disclosure rules are being considered. The only other thing I'd add is, this investor season, proxy season, is just one of the things that boards and managements are going to need to deal with because, the pressure, for example, on corporate political activity is not coming so much from investors. It's coming from your employees and your senior management. As we come up to the anniversary of the January 6th riot, as more issues, including women's reproductive rights, may be tossed to the states, you're going to be having a sort of tsunami of not just investor interest in ESG, but your other stakeholders' interest in a lot of social and environmental issues. So be prepared to get hit from multiple directions if you're sitting in a boardroom when it comes to environmental and social issues. And sorry not to end the year on a happier note, but that's coming.
Yeah. And speaking of other things that are coming, and you alluded to this, we have a question from the audience. Yesterday, we heard from the head of the IFRS about the evolving sustainability disclosure standards. How do you think that can ultimately change things? I mean, we've already seen a lot of proposals saying disclose this and disclose that. So if that then becomes regulation, how might that impact some of these proposals? Michael?
So one thought I would have on this one is that I think it's a no-brainer that we'll soon have mandatory disclosure requirements on certain issues like carbon emissions, for instance. But we also shouldn't overestimate how well developed our ideas are outside of carbon. I think a lot of investors end up over-indexing on how clear that case is for what should be reported and how. And one way you can see this is if you look at independent ESG ratings providers, the huge degree of disagreement between what counts as a good ESG stock or what doesn't, or how do you measure some of the broader social factors. So I think you'll see, thankfully, you'll see some regulation, some standards going in place, but we should overestimate how many areas there are that there's broad enough agreement for that to happen. I think we're at the beginning of a very long road when it comes to extra financial reporting.
Yeah, I just jump in if I might. That you're going to see some consistent mandatory requirements in diversity and in carbon emissions and greenhouse gas emissions. That's pretty clear. It's going to still be a sort of Wild West a little bit when it comes to disclosures in these requirements in other areas. And we recently put out a piece on the harmonization of sustainability reporting frameworks. It's going to take a long time. There's going to be greater alignment, but there's not going to be consolidation in a meaningful way for quite some time. So I don't see the pressure letting up. In fact, what we're seeing is environmental topics that go beyond carbon into water and biodiversity and so forth. Those are only going to increase as well. So even if they simmer down in one area, you're going to see them in others.
I mean, I wouldn't be surprised to see it kind of exposed, companies that have been making these types of disclosures prior to the clarification that's provided and versus, what is actually happening in corporations. I mean, there's been a lot of discussion about, what does quote unquote green really mean? And I wouldn't be surprised to see, wide variance in terms of the actual condition at corporations that are making these types of disclosures. And I think that's really going to be a focus as we go into 2022 and the rules are clarified.
Mm-hmm.
Great. Yeah. I think that makes a lot of sense. So and we are up on time, unfortunately, but Rebecca, Michael, Paul, this has been great. Thank you very much for sharing your insights. And it's been a pleasure to having all of you and our great audience members as well at the Bloomberg Sustainable Business Summit, Focus on Finance.